and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Ben Poole, writer at CTMfile. Welcome back, Ben, to another episode of the Open Treasury podcast.
Thanks, Push. Looking forward to diving into these topics.
We truly appreciate your time and insights as we delve into the critical topics shaping the landscape of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely trade finance to play a substantial role in tokenized real-world assets market by 2034. Data confirms that the UK is out of technical recession. Brazil plans to become a major supplier of rare earth metals. And finally, China Plus One strategy makes Southeast Asia favorite for diversifying supply chains. Our audience can watch videos on the CTMfile YouTube channel and explore insightful articles, interviews, and industry roundups on CTMfile.com, either by visiting the website or by following the links provided in our show notes. Let's begin today's discussion with our first story, which is about trade finance expected to become one of the top 3 tokenized assets globally. Demand for overall tokenized assets could reach $30.1 trillion, US $30.1 trillion by 2034, and trade finance assets could become one of the top 3 tokenized assets globally at 16% of the total. This is one of the key findings in a paper published by Standard Chartered and SynPulse. Real-world asset tokenization, a game changer for global trade, notes that global trade is projected to reach $32.6 trillion globally by 2030, and this combined with growing industry digitization and the specific features of real-world trade finance assets makes it an ideal category to originate tokens. The tokenized assets sector mainly comprises traditional assets like US Treasuries and money market funds. However, the supply side is still in its infancy, with the total value of tokenized assets, excluding stablecoins, at around $5 billion in early 2024. Despite its attractiveness as an opportunity to diversify risk, trade finance assets are underinvested due to lack of familiarity, pricing inconsistency, and operational intensity. Tokenization has the potential to address these challenges while also reducing information asymmetry and offering transparency to investors. Ben, you covered the story for CTMfile. How do you think digital representations of real or traditional assets in the form of a token or distributed ledger can be of benefit to corporations or their treasury departments?
Thanks, Push. Yeah, it's a really interesting report, well worth a read on the website. I think the tokenization of assets gives the sort of efficiency, the visibility, the transparency across kind of an end-to-end supply chain in any financial relationship, particularly in the trade finance area. And as the report says, these assets aren't as far along their tokenization journey as things like money market funds or US Treasuries. So there's a lot of work still to be done before this is going to be something that's relevant, particularly for treasurers. It's going to take a lot of collaboration amongst all stakeholders in trade finance, investors, financial institutions, governments, regulators, to make sure that the whole ecosystem is ready for this to take off in the trade finance space. The report notes, obviously, Standard Chartered would kind of flag up what they're doing, but they note that they've been involved in a couple of initiatives like Project Guardian, which is a collaboration between policymakers and the financial industry to enhance liquidity and efficiency of financial markets through asset tokenization, and also Project Dynamo, which is looking at how to use technology to support SME financing. So for treasurers, these are interesting developments, of course, because they directly touch upon the relationships between corporates and their suppliers. So part of Project Dynamo that I mentioned explored the programmability of digital tokens on a public blockchain. And that project demonstrated the use of an electronic bill of lading as a condition for triggering payment, which is kind of a marriage between the digitalization of the trade world and of the finance world as well. And that prototype also showcased the use of digital identity for conducting due diligence of SMEs and suppliers. And on that particular point, treasurers can make a start on that side of things today by looking to adopt the legal entity identifier, or the LEI as it's known. This is a 20-digit alphanumeric code. It's a globally consistent file format from ISO that identifies any legal entity. It contains unique information such as the name and the address for any entity worldwide. And there's some good use cases already today for the LEI in Treasury that are mainly related to cross-border payments. So things like faster and cheaper KYC, know your customer, around customer onboarding, better fraud detection, greater account-to-account owner validation, and better efficiency in sanctions screening. So corporates can match what they have on file for their suppliers with the information that's out there publicly for this today. And also, I think they need to check with their banks, urge their banks almost, to include the LEI field in their ISO 20022 message formats. Now, we've spoken a lot about the transition to ISO 20022 before, but previously there wasn't a field for the LEI on legacy payment formats, if you will, but with ISO 20022 there is. So that's something that can help treasurers already today in some of those use cases I mentioned. And it also really helps prepare the ground for the future when everything, when we're looking at tokenization, we're looking at digitalization, including these trade finance assets, something like the LEI that is already embedded in there, integrated into their payments, will be so important. So that's kind of a first step. It's not really tokenizing anything, but it is getting you on that path to be ready.
Well, that's a thought-provoking perspective, Ben. Thank you for shedding light on this topic. Next up, let's delve into the second story, which is about the UK emerging out of a technical recession. UK gross domestic product, or GDP, is estimated to have increased by 0.7% in Q1 2024, according to data from the Office for National Statistics. This has been revised up from a first estimate increase of 0.6%. GDP is estimated to have increased by 0.3% in Q1 2024 compared with the same quarter a year ago. In output terms, services grew by 0.8% in the quarter, with widespread growth across the sector. This follows 3 consecutive quarters of decline. The largest contributor to the growth in services output was a 1.8% increase in the professional, scientific and technical activities subsector. This was primarily driven by growth of 7.2% in scientific research and development and growth of 3.3% in legal activities. Commenting on the UK GDP data, Douglas Grant, Group CEO of Manx Financial Group, said, "The most recent GDP figures in the UK serve as a stark reminder that despite certain recent positive indicators, challenges still persist for UK businesses." Moreover, the winners of Britain's election, according to a recently published article in Reuters, will take on some of the biggest challenges faced by any new government since the end of World War II. Ben, you are based in the UK and have a thorough understanding of treasury management and business economics. From a corporate treasury perspective, what specific challenges do you foresee for corporations operating in the UK in the near future? And can you suggest 1 or 2 measures that corporate treasury departments should adopt to mitigate these challenges?
Yeah, you mentioned obviously the UK election is happening this week on Thursday the 4th, so by Friday the 5th we'll know which party will be running the government. Had a quick look at the BBC's poll tracker online before we came on today, and that has the incumbent Conservative government getting 20% of the vote, which is even lower polling than that brief time that Liz Truss was Prime Minister, so that's not great for them, and the opposition Labour Party polling at 40%. So it is widely expected that the UK will have a Labour government post-election and a new Prime Minister in Keir Starmer. Despite the prospect of a first Labour government in 14 years, the consensus is that the election result won't cause any significant changes to the financial markets, which is really interesting. So it's kind of business as usual as far as the markets are concerned. But as that quote made clear, there are challenges, severe challenges in some cases, to the UK economy. A lot of this is still kind of the fallout and just outcome of Brexit. Companies have been more cautious about investing in the UK since 2016, which was the year of the Brexit referendum. And the Reuters story that you referred to in the question notes that France, which has long trailed the UK in terms of business investment, has overtaken it since that time. So not great. And then you've got obviously companies that are based in the UK that are facing various challenges when it comes to doing business abroad. As a result, it has exacerbated supply chain disruptions for British companies. A survey from DDC FPO found that 67% of UK companies have experienced Brexit-related delays from third-party suppliers, and 53% reported an increase in goods being held in customs. Obviously, also exiting the single market also means that UK-based businesses are liable to pay VAT on all goods and services sold in the EU. So that's particularly impacted UK-based e-commerce retailers who are finding it very hard to be competitive compared to their European-based rivals as a result of that. And then there's the sheer amount of additional documentation that's required if you're a UK company exporting to the continent or also importing parts and services from the EU. The Office for National Statistics had a survey that showed around 38% of exporters and 39% of importers have identified form filling as their main hurdle. So you can kind of understand when you put all those together why some corporates chose to relocate their headquarters from the UK to mainland Europe as a result of the various impacts of Brexit. But thinking about all those challenges, for those that remain, there's a few things that companies can do to try and mitigate some of the harshest impacts. You know, a thorough supply chain review can help determine perhaps where there's room for improvement in terms of resilience and sustainability as well. Technology might be helpful when it comes to handling some of the repetitive admin tasks. We speak a lot about AI, and AI might be particularly relevant to things like scenario analysis for risk management, even things like optimizing export routes and minimizing freight billing errors, stuff like that. So there are things that corporates can do to try and mitigate those impacts. And there was some good news for the UK this week. There was a report from KPMG that was in Tuesday's industry roundup on CTMfile, noting GDP growth for this year. They've revised their figures up to 0.5%, which doesn't sound much, an upgrade from 0.3% and against growth of 0.1% last year. But KPMG anticipates that the Bank of England's base rate could decrease to around 3% next year from the current 16-year high of 5.25%. So that's thanks to inflation finally sort of getting back on a par with the level that the BOE wants it to be at. And also the UK was a bit of an outlier with inflation in terms of that sticking around longer than EU inflation and US inflation. It was definitely higher for longer, to quote a phrase that's going around a little bit at the moment. So there is some good news, there is some bad news, and companies will do their best to try and mitigate the risks that they face. I mean, that's really kind of core to the job of the treasurer in terms of financial risk management.
Well, Ben, thank you for the insightful analysis. It adds great value to the conversation. Let's shift the discussion to the third news story, which is about Brazil announcing that it plans to become a major producer of rare earth metals as Western countries push to gain supplies needed to manufacture high technology devices. Rare earth metals are 17 elements that are important to electronic equipment and to batteries, electricity storage devices. South America's largest country could become a competitor to China, which currently produces much of the world's supply of the rare earth metals. Brazilian officials have to move the country into the world's top 5 suppliers. Supporters of Brazil's push say low labor costs, existing rules, and being close to markets in Latin America will support its ambitions, although current low prices for rare earth metals, technical difficulties, and concerns from possible lenders present problems. Ben, with Brazil's plans to become a major producer of rare earth metals and potentially challenging China's dominance, how do you foresee this affecting the supply chain and procurement strategies of global corporations?
It is a fascinating development in the high-tech battery race and chip race, I suppose, particularly when considering the US plans to develop its own supply chain for rare earth metals by 2027. So perhaps you might see something akin to a new gold rush over Brazil's resources if there's the finds that are being made over there and the possibility of developing new mines. I mean, the one thing that I really thought about with this is the sustainability question. And that is something that corporates might have to think about. Rare earth metals are mined by digging vast open pits in the ground, and they can contaminate the environment and disrupt ecosystems. If they're poorly regulated, mining can produce wastewater ponds filled with acids and heavy metals and radioactive material that could leak into groundwater, for example. So obviously that raises huge questions for the mining companies, whoever is winning the contracts to do this. But there are Treasury considerations if that activity makes up any part of their supply chain. It might mean that they find it hard to benefit from ESG related financing, for example, and other sustainable finance products. So not really answering your supply chain question, but that was just the main thing that popped into my head reading about this story. It's exciting in one way. It's a way to, like you say, that potentially have the option to diversify supply chains away from China as a result of this, but that it's not without risk. And so, as always, caution is recommended, and just it kind of highlights the need to really get visibility into a corporate supply chain. If you're the treasurer at the top of that supply chain, you might know what your nearest supplier, your most direct supplier does, but do you know what their suppliers are doing and where everything's being sourced from? So that's just one of those things that I know has been a lot higher up on the Treasury radar in recent years. And I think this just shows that it's there for good reason, and having that visibility is so important.
Well, you've raised some interesting points, Ben. Now let's turn our attention to the fourth story, which is centered on Southeast Asia. Southeast Asia is becoming a top choice for firms looking to diversify production away from China, including Chinese companies, amid escalating trade tensions between the US and China. The region is benefiting from the China Plus One strategy adopted by many manufacturers that seeks to reduce the risks associated with total reliance on China's market or supply chain through diversifying manufacturing operations, expanding into other countries while still maintaining a presence in China. Southeast Asia is well placed to benefit significantly from the China Plus One phenomenon as both foreign and Chinese companies diversify their supply chains and operations, said Kyo Yi Lim, co-founder and managing partner of Southeast Asian venture capital firm Monks Hill Ventures. Geopolitical tensions have accelerated these activities, which started during the COVID lockdowns. The trend has spurred greater investment into the ASEAN bloc. Foreign direct investment into the ASEAN economies of Indonesia, Malaysia, Philippines, Thailand, Singapore, and Vietnam rose to $236 billion in 2023 compared with an annual average of $190 billion between 2020 and 2022. Overseas Chinese Banking Corp, or OCBC, economists reported last month. The inflows mostly came from the US, Japan, the European Union, as well as mainland China and Hong Kong. Ben, amid escalating US-China trade tensions, Southeast Asia is emerging as a top choice for corporations looking to diversify production away from China. Additionally, as you know, India and Mexico are emerging as reliable alternative destinations for manufacturers and supply chain diversification. Ben, do you think the global effort to diversify supply chains beyond China will create significant opportunities for India, Southeast Asia, and Mexico in the foreseeable future? Or do you believe the mutually beneficial relationships that China has forged with numerous multinational companies over decades will make it undesirable or unrealistic for many of them to make a complete break with China anytime soon?
Oh, that's a good question, Push. I think a complete break is probably not what most companies are looking for. I think diversification doesn't mean shutting off your main source of supplier. It's about trying to make sure that you've got more taps that you can turn on and off as and when you need to for whatever reasons. I think this story kind of highlights the fact that supply chains are moving and that corporates don't want to have all their eggs in one basket in China. The fact that foreign direct investment into the ASEAN economy was up to $236 billion US in 2023 from an annual average of $190 billion in 2020 to 2022. That's up over a quarter, so that feels significant. And I think that's a number to track in coming years. But I think that highlights the start of that movement. I think it highlights also the impacts that a change of strategy in some of the world's largest multinationals can have to different countries' economies around the world. And where those companies lead, it shows that it can be a viable strategy for other firms to then follow. New infrastructure and export routes and capacities are required to help make this sort of change a success. So you could well see more companies being increasingly open to moving elements of their supply chains in this way and taking advantage of some of the pioneering tracks laid out by the early adopters, I think. So I think it's a trend that we'll see continue, particularly as just watching kind of geopolitical stories and how things might change over the next 12 months or so. So yeah, I definitely think it's a trend that's going to be ongoing.
That's an intriguing take on the subject, Ben. Finally, what is your choice for the biggest or most important story of the past week and why?
Well, the news cycle here is absolutely dominated by the election and the football with the European Championships on at the moment. So there's not a great deal of news here apart from that. But one story I did want to point out is a fascinating article that you published, Push, on CTMfile this week, looking at how M&A deal activity is expected to increase this year. In that, you note how in the wake of 2 years of declining deal volumes, 81% of M&A professionals foresee an increase or substantial increase in transaction volumes in the next 6 months, while I think it's only 4% to expect a decline in deal volume. So that's a really interesting article. You do a great job at exploring the various drivers behind that potential M&A bounce back in 2024. Just encourage everyone listening to head to CTMfile.com to check out that article if they've not read it already.
Well, thank you, Ben. That's really kind of you. We've reached the conclusion of this episode, and we are grateful for your discerning and valuable insights, Ben. Many thanks. We also want to extend our appreciation to our CTMfile audience for tuning into this edition of the Open Treasury podcast. Thank you for your time and attention. Please don't forget to subscribe and check the show notes for links to the articles discussed. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.